Well, joining us more now is Kerry Craig from JP Morgan. Kerry, great to have you back on AusBiz. Thanks for joining us. So, obviously, focus on the Fed decision overnight. As expected, leaving rates on hold. It's more about what's ahead. In particular, I guess, its adjustment as far as Donald Trump's policies are concerned.
Thanks, Andrew, and yeah, thank you for having me back on the show this year. I mean, for us, it's the Fed have been slightly tinging to the hawkishness. When we look at the statement in the press conference we got from Jerome Powell. Obviously, Chair Powell wouldn't be drawn on any of the government policy initiatives. We're only 1 week into the new administration, and they're clearly saying, the Fed that is, that they want to see more in terms of how these policies evolve because they know they're going to have an effect on monetary policy in terms of what it means for inflation and growth for the economy. And they want to wait and see those develop. And if we look at the broader stance of the US economy, growth is running probably a little bit above 2%. We've got inflation that's coming down towards target, but still a little bit away from that 2% target. And so there's probably a little bit of a warm economy the Federal Reserve is just conscious of, and they don't really feel the need. They need to be pushed to cut rates further after already delivering 100 basis points of easing so far in this cycle. So very much wait and see mode from the Fed, and really waiting to see how those policies develop and what it means for the incoming economic data, as they always say.
What do you make of the market pricing in fewer rate cuts ahead this year?
Yeah, you've shifted from seeing something like 125 basis points of rate cuts being priced to the market now to less than two, so under 50 basis points being priced. And that's dramatically had that big effect on where we've seen bond yields move since September of last year when it became evident that we were going to get a change in that administration in the US. I think for now, we're still looking at 1 to 2 cuts from the Federal Reserve, heading towards 4% on the Fed funds rate. The risk of it seeing a much lower rate cut would really be to see something like a full-blown trade war where growth was quite anemic. But I think the bar to raising rates is also very high as well. So we need to see a lot more inflation for the Fed to go a lot higher. So that gradual path downwards, a few more rate cuts coming through, I think is the likely trajectory from the Fed, but it will be 1, maybe 2 from here. So a relatively shallow path for easing in this cycle relative to other ones.
How's that all translating as far as what we're seeing on the equity market at the moment? Kerry, of course, we are still in the midst of earnings season. A number of big tech companies out today, including Microsoft and Tesla. Of course, this also coming this week, given that seismic shift we've seen in that space in AI-related tech stocks.
Yeah, I'm sure there's going to be quite a few tough questions from analysts on the earning calls from those companies. But I think for us, when we look at what happened on Monday, the whole sort of idea around DeepSeek coming back and challenging the idea around the cost of building AI, I think that really has an implication for near-term earnings. The question is always around this projected capex spend that these very large mega caps in the US are putting out, the heavy investment in R&D to try and develop these AI technologies as they move to that more generative AI intelligence. I think the shift here, though, we're seeing is that clearly we have had this company coming out saying we can do this for relatively cheaper cost and with technology that's probably slightly behind what the companies in the US are doing. This competition should be seen as something that can lead to greater innovation, though. And I think it just sort of raises the threshold for what these very large companies in the US will try to achieve. But I don't think it's going to shift those sort of capex intentions to a large degree, given that the numbers we saw coming out of the DeepSeek in terms of the cost it cost them to actually produce that, there's a lot of debate around that number in terms of did it really capture the full R&D or just the cost of training that large model. Whereas in the US, we're seeing a big commitment to building a whole infrastructure for AI across the economy. And I don't think that's going to change. It may be just that trying to level up and get up to that next level of that technology may come a little bit sooner if there's a little bit more competition out there. So for the earnings season, I think it's going to be a focus on what we've seen so far, and we're tracking about 12% earnings growth this season, even though we've only had about 20% of companies report. And that secular theme around AI is not really going to go away, and the earnings from these companies will look relatively robust. We've already seen pretty good earnings come out of financials so far as well this season.
So, Kerry, is it your view there at JP Morgan that we're likely to continue to see the US market, equity market, outperform relative to its global peers, reflecting that American exceptionalism?
You've got profit margins that are still going up and expected to rise higher. You've got valuations that are very elevated across pockets of the US market. And I think what you'll see there is a further rotation into other areas away from those big mega cap names to the rest of the market. So I mentioned financials already. a lot of the American first policies we're seeing coming out of the administration should help boost things like industrials. And you will also see catch up in other areas as well that are more cyclically orientated, given the growth prospects for the US economy looks relatively good. And the consumer is very well supported at the moment in the US as well. So all that plays through to seeing that broaden out into those other 493 or 490 companies in the US market, where we see earnings growth starting to pick up relative to where it has been. And I think that will keep the market in the US ticking up above what we've seen elsewhere in the world, where we still have those concerns around growth and inflation, such as in Europe. And again, the valuations argument always comes up with clients. Valuations matter a lot for the long run, but in the short run, it's around the earnings growth potential, and there's more of that in the US at the moment than there is in other places in the world.
Kerry, shifting our focus back home here to Australia, and certainly some optimism emerging yesterday in the prospect of imminent rate cuts off the back of a positive inflation read.
Yeah, the RBA has been holding out for rates and wanting to see more clarity around that inflation figure coming down. They've also set the case up with a very sort of dovish tone to their last meeting back in December. And so I think the case for seeing that rate cut come through in next week would be very high. I mean, sequentially, inflation has been coming down back towards their target, well within the band. If we look at what it's done over the last 6 months or so, there's probably greater clarity around the government initiatives coming through, the fact that you might have these more stimulatory aspects come through that could raise inflation. But I think on the balance, we're seeing softness in the labor market as well that would help ease the Federal Reserve's concerns. And you've got this plethora of uncertainty around the world that could create a bit of a growth shock as well, which would allow the the RBA to cut rates to try and create a bit of a buffer. However, I think the RBA, when they do meet, if they do cut rates, will be very cautious on the path for those rate cuts that will be likely in tune with the quarterly inflation numbers. And so we're only expecting, say, 4 rate cuts over the coming year. And again, that's a relatively shallow path for rate cuts from the RBA, given that growth has been quite soft in Australia.
And Kerry, what's your view on Australian equities at the moment? I guess particularly when we look at the 2 largest sectors, the banks continuing to show strength, resources though remaining under pressure.
Yeah, I mean, 2024 was a case of that huge revaluation we saw in the financial sector moving up and at the expense of many other things in the market. You know, overall, the earnings outlook for Australia's better in 2025 than it is in 2024, but still relatively soft compared to other markets around the world. There's also that concern around the Chinese growth outlook and what that could do to sentiment in Australia, as well as a broader cyclical downturn if there was a trade war that did kick off. However, I think this year it's going to be a reversal of what we saw last year, that we can't really expect a third year of valuation re-rating out of those financials. We would expect to see more rotation towards the resources named and then towards the material sector more broadly, but we'd also be looking for areas of opportunity, say within consumer discretionary, given that the household sector should start to benefit from those tax cuts, as well as falling inflation and policy rate cuts from the RBA. And we're looking for catch up in other areas such as healthcare, which didn't do so well, as well as REITs. It's very clearly linked to lower rates. REITs would be another sector we'd expect to perform well this year. So all that would suggest a movement away from the banks, given their valuations have moved up a lot.